Hello and welcome to this video. In this particular video, we are going to be looking at one of my recent trades where the underlying stock had a 50% downward move against me because I had a kind of a long position uh, on that stock, but still I did not make even a penny of loss. And basically, all the concepts and principles that I have been discussing in my other videos, those have been applied to this particular trade, and you can see the results for yourself that even though the underlying stock moved against me by 50%, more than 50% in fact, I did not take a penny's loss. And also, this was not at the cost of a possible upside potential. I had a possible upside potential which, when annualized, was more than 160%. So stay tuned till the end because we are going to take a look at all the details of this amazing trade that I executed. And although this trade did not go in my favor, but I was very happy with this trade because my risk management, the strategy that I wanted to deploy, worked perfectly in this situation, and that saved me from a massive drawdown on my account. So, as Warren Buffett has said, the one thing that you should never forget is that you should not lose your money. And this particular trade is an example of my strategy where I create multiple layers of cushions to make sure that even though the underlying stock really goes against me, I don't take any kind of losses. So, a quick preview as to what all we will be covering. The trade that I executed was on the ticker symbol APLS, which is APLS Pharmaceuticals. So, we'll take a detailed look at the dynamics of the trade and exactly what trade I executed and how I executed it. Then we'll also see how I created multiple layers of downside protection, which basically prevented me from taking any kind of losses, although the underlying stock went massively against me. Besides that, what I'm going to do is I'm going to compare my trade with a trade that a regular investor would have executed by simply going long the stock, and we'll compare what kind of losses would that kind of an investor be seeing as compared to me. Before we proceed, a quick look at the disclaimer, which basically states that whatever information I'm sharing with you is only for entertainment purposes. It is not any kind of trading or investment advice. So this is the chart of APLS as I was seeing on 9th September 2021 when I basically executed the trade. And if you look at this chart, some of the principles that I discussed in my other videos I had applied. So one of the things that I discuss is to always buy stocks at a discount or at a sale and not when they're trading at their highs. So you can see here that the recent highs of this stock were around $73. It's gone to the $73 mark, and very often it was touching the $70 mark, but I wasn't buying shares of this company at $70. This particular stock had a recent support, pretty strong support at around the $54 $55 levels, and once again it had returned to the same levels, and at this level again it was looking to form a bullish green candle, and this is where I was planning to basically get in, go long into this particular trade. So you can see here that in this particular example, both the rules, that means buying close to support levels and staying away from buying stocks at their highs, both the principles were being satisfied. If you look at the time when I was getting into the trade, the analyst recommendations were all positive about this particular stock. The fundamentals of this stock looked good, and everything was perfectly set up for this to simply rebound from this point and essentially for me to have a profitable trade. But then there's one more rule which I have discussed, which I call my golden rule, and what states that when things can go wrong, they will eventually go wrong. And so you have to be prepared to make sure that you are ready for the worst possible. And keeping that in mind and not getting greedy, basically controlling the emotional part of my trading, that this is a wonderful setup, everything is looking absolutely green, the fundamentals are right, the technicals are right, the analyst recommendation is a strong buy, chart is set up properly, there indicates that buyers are stepping up and they're taking control of the stock. So everything seems to have lined up here, right? And this is a perfect setup where a lot of people will end up going long the stock. So if somebody would have gone on and bought the shares at $55, I would not say that's a very bad trade. Although in that particular situation, I would recommend that people would have put a stop loss. But still, buying in at $55, looking at the setup, the analyst recommendations, the fundamentals of the company, everything looked absolutely good here. So this was an ideal setup for going long in this particular stock. So this is the trade I actually ended up executing. Instead of going long this particular stock, I actually ended up selling the $30 puts on this particular stock. So I'll just give you a couple of seconds to let that sink in. Uh, I am not going to buy shares of this company at the high levels, which is at $73, close to $70, thinking that the stock is going to go up. Because if I do that, then I'm going against my principle, which basically states that you should be getting into positions into stocks at a discount, at a sale, and not when they're expensive. A lot of people will get in when the stocks are forming new highs, when they see a small breakout, thinking that it's going higher and it's going to continue going higher. We need to understand one thing: we cannot expect the stock or the market to do something that we want it to do, because that's not going to work out for us. Rather, we need to understand the price action and then use it in our favor. So a lot of people lose money because when the stock is trading at their highs and they're trying to make a new high, they feel that the stock is going to continue going up. What they need to understand is that if the stock price has gone up, possibly the factor that was resulting in that upward move is now already factored into the price, and the stock may be nearing exhaustion, because definitely something which has gone up may or may not go up further, but something which has come down significantly has a higher chance of going up, provided the fundamentals, the investor sentiment, the analyst recommendations on those stock are all still positive. So with that principle in mind, the first thing you have to understand is I did not buy the stock at their highs. That means at around the $70 levels where a lot of people would have been looking for breakouts and buying in, I'm not buying at that price. Now, when the stock is trading close to its support at around $55, I am still not buying shares at $55. I want to reduce my cost basis even further. So what I end up doing is I end up selling the $30 puts, which means that in case the price of APLS falls down all the way down to $30, then I would end up buying 100 shares of APLS at an average price of $30 per share. So that's a massive cushion which I'm creating. So you have to understand the multiple layers of cushion that I'm creating, as opposed to a person who's trading breakouts who would have bought at $70 plus levels. I'm not buying there. I'm creating my first cushion. I'm buying at $55 levels. Then again, I'm not buying at $55 levels. I'm actually going down further and selling the $30 puts. So I'm getting into a contract that I will buy the shares only if the price falls below $30. And then from the screen that is visible right now from the order, you can see that here I collected $4.20 in premium as well. That means, although I'm giving a commitment by selling this put option to buy shares at $30, but I've already received this premium of $4.20, which means the effective cost basis for me is down by another $4.20. So, if at all the price of APLS falls below $30, my effective cost basis is not going to be 30, it's going to be 30 minus 4.2, which is $25.8. So you understand the different levels of cushions that I'm putting in, as opposed to a conventional trader, a retail trader who's trying to maybe trade the breakouts, right? So I'm not buying at 73, I'm not buying at 55. My cost basis finally is not even going to be $30. It's going to be way down at $25.80. And all this, what it implies is that for me to start making a loss, the price of APLS needs to fall down all the way from $55 to $25.80. And that's where I start taking a loss. If that happens as well, then I can always sell another call option against the shares that I have just purchased, converting this into a covered call and then further reducing my cost basis. So you can see how in this strategy I'm creating multiple levels of cushion which give me a huge room to be wrong. Even when I know that after doing my due diligence, after carrying out the analysis, after looking at analyst recommendations, the fundamentals, the technicals, the stock seems to be a strong buy. So now although I've explained all this, let's look at all the figures once again that I've mentioned here. So when I got into the trade, APLS was trading at $55.20. Then, as I mentioned, I've selected the $30 strike for selling the puts. I collected $420 of premium. The break even price that I just mentioned was $25.80. So this is the price. If APLS keeps falling down, it reaches $25.80. At that price point, I don't make any losses. My net loss is zero. Only when the share price falls below $25.80 is when I start to make a loss. The net margin requirement, if you don't have a margin account, like let's say if you're trading on something like Robinhood on the non-margin account, then what will happen is that for making this trade, you would be required to put up a capital of $2,580. So that would be the money, the cash that you need to have in your account in order to be able to sell one put, basically execute the trade that I have mentioned here. So let's say this is the capital that we need in order to get into this trade. The max profit is $420. So if you consider this max profit as a percentage of the money that I have to put up, it is 16.27%. And since I took the trade on 9th September and with the options expiring on 15th October, that is 37 days. So I would have made the 16.27% profit in 37 days, giving me an annualized return of 160.59%. So I have done all the calculations for you and put everything right in front of you so that you can get a complete understanding of this trade. So if it's not clear in one go, please watch through this section time and again to clearly understand what I'm trying to convey here. This trade is basically giving me a huge upside potential. It's not that I'm taking a low risk trade and thereby I'm reducing my upside potential to a very low value. No, I'm not doing that. I'm looking at an upside potential which, when annualized, is giving me more than 160% return. But at the same time, now this is the last point is the main thing here, which is the downside protection. How much downside protection do I have? That is 53.26%, because the stock is right now, when I took the trade, it was trading at $55.20, and as I've explained earlier, it could go all the way down to $25.80, and I would still not make a loss. I would start making a loss only if the price fell below, further below $25.80. And so if you do the calculation of how much the stock can fall before I start making a loss, that is 53.26%. So just give yourself a couple of seconds to let this sink. How often can you find trades which give you a downside protection of 53.26%? That means you don't start taking any kind of losses as long as the stock doesn't fall more than 53.26%. But you still, if things go in your favor, if the stock stays above $30 in this particular case, you still have the potential to make a 160% plus annualized return. So this is the kind of trade which basically will help your account grow in one direction, which is the positive direction. Because if you remember my golden rule, I have called it out multiple times that the most important thing for any successful trader is to preserve their capital. Traders do not become unsuccessful because they don't have profitable trades. You will eventually have profitable trades, whether it's based on your analysis or whether it's just by luck, but you will have trades which make you money. The reason why traders, retail traders especially, are unsuccessful is because in fact many times they have a streak of winning trades, 3 or 4 trades, all of which make them money, but then they will end up with one bad trade which takes away all the gains and gives them a net loss. So that loser is so big that it draws down the account so much that those traders are never able to recover from that drawdown. So if you want to call it my rule, you can think about it that way. Or even if you want to listen to great investors like Warren Buffett, his main rule is never lose money, and his second rule is never forget rule number one, which is not to lose money. So that's why I'm repeating this again and again, so that this becomes very clear that the one thing that you should do if you want to be a successful trader is make sure that you're giving yourself enough chance to be wrong, because nobody can predict the markets with 100% accuracy. In fact, all that we are trying to do is take a best guess and trying to increase the odds or the probability of understanding whether the market is going to go up or down. Nobody can perfectly know what's going to happen tomorrow, because in this particular case, the reason for the fall in price was an FDA rejection. Now, nobody was anticipating that the FDA rejection would happen. In fact, it was not even a rejection. They had two drugs, out of which one had a positive outcome, one had a negative outcome, which they wanted to basically, I would not even say it was a negative outcome, it was a non positive outcome. And the market reacted in such a negative way that they brought down the price by 50%. So, as far as I'm concerned, this was an overreaction for news which was not positive, but the market reacted in a negative way to it, right? So you can't really predict how the markets are going to exactly react to any kind of information which comes up. So although you may have done absolutely amazing analysis on any stock, if you want to be a successful trader, you need to build these cushions, you need to build these barriers for yourself which give you a chance to be wrong. You have to work with the assumption, which I mentioned in my golden rule, that when things can go wrong, they will actually go wrong. And successful traders are the ones who factor in those eventualities into their trade, into their risk management, and they have a plan laid out. If you're trying to plan what will you do, I just mentioned, right? I already took a trade which had all the built-in elements to give me enough cushion. And also, I just mentioned that in case, let's say the puts were assigned and I ended up buying the shares of APLS at a cost basis of $25.80, then I would have sold the calls to convert this into a covered call and further reduce my cost basis. So if you see, my plan is ready. I know that the stock can fall by a certain amount and it's not going to fall by 100%. In the worst possible scenario, it may fall by 50, 60, 70%, but I have a plan on how to handle that situation. The probability of that situation may be as low as possible based on my analysis, but if that happens, I don't want to be in a situation where I'm panicking and I don't know what to do and I take wrong trades and I basically end up losing a lot of money. So I hope the message here is clear. You need to give yourself enough room to be wrong. And this particular trade is one of the perfect examples on how I basically made sure that those principles, the concepts that I have been discussing in my other videos are actually applied. So this trade actually captures all of that content in action. And if you've not gone through the rest of my videos, I would strongly recommend that you go through them, so that even if you take trades and you end up with the worst kind of situation, that the stock goes against you by more than 50%, if you can come out untouched, if you can come out without taking any kind of losses, that's the best kind of thing that can happen. Because you have to understand, this trade, I'm going to compare it later to the kind of trade that a regular investor would have taken who's not following this strategy, and the kind of loss they would have taken, how much time it would have taken them to recover from those kind of losses. So we'll take a look at that as well later. So this is what happened to APLS after I executed the trade. So if you remember the chart earlier, this is where I took the trade. This is the $55 level, and everything looked like this is a support and the price is going to go up. And the very next day, this is 9th September, and on 10th September, see what happened. This stock went to a low, it gapped down, massive gap down, and then it went to a low of $27.50. So now let that sink in again for a couple of seconds. I take the trade on 9th September. The stock is trading at $55 and looking extremely bullish. On 10th September, the stock goes way against me. It falls down by more than 50% to $27.50 low during the day. Okay, so this is basically what has happened here. And most accounts would take a massive hit when this kind of a drawdown or a fall in price of the stock happens. Okay, so you can just look at the chart and understand that whatever upward move had happened in months was taken back. It was eaten away within a single day. Now earlier, when it was trading at 27 levels is probably here, right? So this one bar represents I mean, this is representing April, I think, here. So you can see here that from April to September, that's close to 6 months, whatever gains the stock had made in 6 months were taken away in a single day. And that's the kind of uh, negative trade that I was facing. So in this case, anybody's account would get decimated. But in my case, now this is the opening trade as well as the closing trade. So first one, you can see that I had sold a put option, and I sold this push put option which we saw earlier, the 30 put. And on 10th of September, one day later, I was able to close the same trade at the same price. If you look at the price of the options, it's exactly the same. So when the stock was trading at $55, this the first trade, the first line here is when I sold the put option, and APLS was trading at $55 at that time, and I was able to capture a premium of $4.20. But the second trade here is when APLS was trading at under $30, if I remember correctly, and at that time I was able to close the trade for 420 again. So I sold for 420 and I bought it back for 420. My net loss on this trade was zero, no profits, no gains. But how many traders do you know who can actually take a trade where the stock goes against them by 50%, more than 50%, and they can come out of that trade without taking a penny's loss? And all this happened because even though I had one of the best setups on one of the best stocks, on one of the stocks which had been hyped by analysts to a certain extent, but I did not forget my rules. I remembered to follow my rules. I remembered to create enough cushion for myself. I gave myself enough opportunity to be wrong, and I did not believe the analysts, I did not believe the fundamentals, I did not believe the technicals. I believed in one thing, that when things can go wrong, they will eventually go wrong, and you must be prepared to be able to handle those things. And that psychology, that mindset is the difference between a successful trader and an unsuccessful trader, or the difference between smart money and the money which is novice, people who don't really understand what they are doing. Okay, so I've summarized the facts here that I had a zero net loss. The stock moved down by more than 50% against me. The only money that I paid here was the commission of $1.30, which was for these two legs, the buy and sell legs, and that's the only money I spent. I believe with all this explanation and the fact that I've re-emphasized a lot of things again and again, it's clear as to the importance of following the principles that I have discussed in multiple videos that I have uploaded to my channel. If you've not seen them, then I would strongly recommend that you go through them and internalize them. And in fact, make it a habit to watch those videos every now and then until those principles become second nature to you. Whenever I'm executing a trade, I don't have to watch these videos, I don't have to do a checklist, because this is now become a regular part of my trading process. I don't execute trades unless I know that I have created sufficient amount of cushion for me. And wherever I have lacked discipline, wherever I have broken my rules, eventually I've had a losing trade. So as long as you can follow the rules, you can have the discipline to make sure that you don't forget those rules, you don't get carried away by a string of successful trades, you don't get carried away by the nature of analysis, or you don't feel that some expert on TV or some expert, some guru has told you that some stock is going to go up. No, nobody knows. The best of the best people in the world did not know that Lehman Brothers would come down one day. The best of the best people in the world did not know that Enron would file for bankruptcy one day. I mean, anybody who knows what's going to happen in the markets, if that were the case, we would not see any financial crisis. We would never see the markets crash, because people in the government, they're pretty intelligent. People in the hedge funds, pension funds, and mutual funds, all these people who are extremely smart and have abundance of resources available to them to analyze the markets, they would know exactly what's going to happen and when it's going to happen. But everybody takes losing trades. And the only people who are successful in the market are the ones who create enough cushion for themselves. I create cushion in my trading using the option premiums and going out of the money. If you look at other investors like Warren Buffett, they create cushion by something called the margin of safety. So people like Warren Buffett, Charlie Munger, they are value investors and they would not buy in a company unless they are able to buy it at a 50% discount. The actual reason for doing that is very simple. They want to be sure that even if their calculations are wrong, even if the stock falls, they have created enough cushion for themselves so that even after the stock moves against them, it would have a value higher than what they purchased it for. So when I say cushions, when I say barriers, when I say multiple levels of protection for you to be wrong, the different ways of creating it, this is the way I do it using options, but you have to understand the basic concept. Now finally, let's compare what would have happened to a traditional trader or a traditional investor who would have just, let's say, gone in and bought 100 shares of this company, looking at the setup that I showed you earlier, where it felt as if the company has good fundamentals, it has got good technicals because it's trading at a very strong support level of $55, and also that the analysts are giving a strong buy recommendation for this particular stock. So somebody who went long 100 shares at an average price of $55.20 would have invested a total sum of $5,520. At the lowest point, APLS traded at $27.50. So I'm assuming that, let's say, a stop loss was not put in place, although mostly people who would have invested in shares, I hope they put a stop loss in, and let's say they put the stop loss 5%, 10% below their trading price of $55.20, they would have lost that money because the trade would have been closed at that 5% or 10% loss. But for the sake of argument, let's just understand that there was no stop loss put, and you basically reached the price of $27.50, which was the lowest price during the day. So the max drawdown that you would see would be worth 2000. The shares actually would be worth $2,750 at the lowest point, and the max drawdown here would be $2,770, or almost 50% of the invested capital. So if somebody was investing $10,000 by buying shares of this company without a stop loss, they would have lost 50% of their capital, more than 50% of their capital in a single day, right? And if you consider the upside potential, how much do you think the stock would have gone up in case somebody was buying 100 shares at $55.20? How much do you think the stock would have gone up? I am pretty sure that most of the stocks will not give you an annualized return of more than 160%. So this is what I'm trying to put across, that the way I trade, the upside potential is not limited. It's pretty high. The annualized return that I was supposed to get in case this trade worked in my favor would have been 160%, more than 160%, which is fairly high. But at the same time, my downside protection is massive. So I hope with this particular video, I have conveyed a practical example of the various concepts, the various strategies that I have discussed in a lot of my other videos. I'll leave a link in the description to all those videos which discuss these concepts, where I have discussed these strategies. And so if you've not gone through them, please go through them. But I wanted to share this trade. This is not a success story. Most people will publish their success stories. This is not a success story. This is not something where I'm showing, you know what, how I made $15,000 in a single day. No, my objective is not to show off with my successful trades. Okay, anybody can do that because every now and then you will have a few successful trades. The real difference between successful traders and unsuccessful traders is one simple thing. Successful traders do not take massive losses. They do take massive winners, but they know how to manage their losses. So every time you're about to take a losing trade, if you learn how to manage that, that means you can manage your losses, right? The winners are going to eventually come in. The winners are going to eventually come in. If you just buy, take a long or a short position in stocks using a throw of a dice, eventually you will have trades which will work out in your favor. The main problem is, how do we manage our losers? How much cushion can we create? How much discipline can we have? So I hope this particular video was useful. So my request is please go through the rest of the videos, and I cover these things in a lot of detail. So my videos are usually a bit lengthy, but then they capture a lot of information. Once you watch that, you don't need to watch too much of other stuff. And if any questions or any queries come up, you can see the comments on all my other videos. I basically respond to most of the queries that come in within a day or two. Uh, in case I'm stuck with something else, it takes a bit longer, but usually I try to respond to most of the comments and the queries that come in pretty fast. So I hope this particular video is useful, and this will basically help you understand the significance of the concepts that I have been trying to put across in the rest of the videos. And if you still have any doubts, if you want any particular concept, any particular topic to be discussed in more detail, please let me know in the comments section. And also let me know in the comment section. It would be great to know if you find this particular trading example as one of the example trades that you would like to execute. Do you think this is a perfect trade where we have a huge upside potential if things don't massively go against us, but at the same time, we have protection for that massive downside so that we don't lose any money? So with that, I'll close this video. If you have any comments, please leave them down in the comment section and I'll respond to that. Please like this video, subscribe to my channel if you've not already done so, and share this video with your family and friends. I hope this was useful, and I will catch you guys up in the next video. Thank you so much for your time.